Welcome to the ultimate guide for new investors eager to make money in the global stock market. This video will walk you through the A to Z of stock market investing, step by step. Whether you're a complete beginner or just curious, we'll keep it simple and packed with the latest insights. Let's start with the basics. What exactly is the stock market? The stock market is a platform where shares of publicly traded companies are bought and sold. When you buy a stock, you're purchasing a small piece of ownership in that company. If the company performs well, your stock's value can increase, leading to potential profits. However, if the company struggles, the stock price may fall, and you could lose money. The global stock market includes major exchanges, like the New York Stock Exchange and Nasdaq. It also includes exchanges in London, Tokyo, Shanghai, and many other financial hubs. Why invest in stocks? Historically, stocks have offered higher returns than savings accounts or bonds. For instance, the S&P 500 has averaged around 10% annual returns over decades. But stocks are not without risks, and prices can fluctuate significantly in the short term. As of April 2025, global markets are facing unique challenges and opportunities. Trade tensions, tariffs, and geopolitical events are creating volatility across markets. Recent U.S. tariffs, particularly on Chinese imports, have shaken investor confidence. Tariffs as high as 145% have been imposed on Chinese goods. This is raising concerns about inflation and slower global economic growth. Central banks, like the Federal Reserve, are also influencing market dynamics. Investors are closely watching whether interest rates will rise or fall this year. Let's begin with A. Assess your financial goals before investing. Ask yourself, are you saving for retirement, a home, or simply wealth building? Your goals will determine your investment strategy and risk tolerance. For example, long-term goals allow for riskier investments like growth stocks. B stands for budget. Only invest money you can afford to lose. Before investing, build an emergency fund with 3 to 6 months of expenses. This ensures you won't need to sell stocks during unexpected financial emergencies. C is for choose your platform. You'll need a brokerage account to trade stocks. Popular platforms include Robinhood, Fidelity, and Charles Schwab. Look for low fees, an easy-to-use interface, and access to research tools. Some platforms also offer fractional shares, letting you buy partial stocks. D is for diversification. Don't put all your eggs in one basket. Spread your investments across different companies, industries, and regions. This reduces the impact if one stock or sector underperforms. For example, combining tech, healthcare, and consumer goods stocks can balance risk. E is for ETF, or exchange-traded funds, a beginner-friendly option. ETFs are baskets of stocks you can buy as a single investment. They provide instant diversification and often have low fees. An S&P 500 ETF, for instance, tracks the 500 largest U.S. companies. F is for fundamental analysis. Research a company's financial health. Look at metrics like earnings, revenue, debt, and profit margins. You can find this information on sites like Yahoo Finance or Bloomberg. Strong fundamentals suggest a company is likely to grow over time. G is for growth stocks. Companies expected to grow faster than the market. Examples include tech giants like Tesla, Nvidia, or emerging AI firms. These stocks can offer high returns but come with higher risks. In 2025, AI-driven growth stocks remain a hot trend. H is for holding period. Decide how long you plan to keep your investments. Long-term investing over 5 years or more often smooths out market volatility. Short-term trading can be riskier and requires constant market monitoring. I is for index funds. Another low-cost way to diversify your portfolio? Index funds track market benchmarks like the Dow Jones or FTSE 100. They're ideal for passive investors who want steady, long-term growth. J is for jargon. The stock market has its own language. Terms like P/E ratio, dividend yield, and market cap can seem confusing. Take time to learn them, but don't let jargon intimidate you. For example, the P/E ratio measures a stock's price relative to its earnings. K is for knowledge. Continuous learning is crucial for success. Read books like The Intelligent Investor by Benjamin Graham to build expertise. Follow financial news on platforms like CNBC or the Wall Street Journal. L is for liquidity. Stocks are generally easy to buy and sell. However, smaller company stocks may have lower liquidity, affecting prices. Stick to well-traded stocks or ETAs to ensure smooth transactions. Margin can amplify both gains and losses, making it risky for beginners. Avoid margin until you have a solid understanding of the market. N is for news. Stay updated on global events that impact stocks. In 2025, trade wars and tariffs are driving market volatility. For example, US chip export restrictions are affecting tech stocks. O is for options. Contracts allowing you to buy or sell stocks at a set price. Options are complex and risky, so study them thoroughly before trading. P is for portfolio, the collection of all your investments. Regularly review your portfolio to ensure it aligns with your goals. Rebalance it if one asset class grows too large or small. Q is for quarterly earnings. Companies report performance every 3 months. Strong earnings can drive stock prices up, while weak ones may cause drops. Follow earnings reports to understand a company's financial health. R is for risk management. Protect your capital with smart strategies. Use stop-loss orders to automatically sell if a stock falls below a set price. Never invest more than you're comfortable losing in a single stock. S is for sectors. The market is divided into groups like tech and healthcare. Each sector reacts differently to economic and political changes. For instance, energy stocks may rise with oil prices, while tech stocks dip. T is for taxes. Profits from stock sales are subject to capital gains tax. In the US, long-term gains held over a year. U is for understanding trends. Markets move in cycles. Bull markets see rising prices, while bear markets experience declines. In 2025, trade tensions are creating a volatile bearish phase. V is for value stocks. Companies trading below their intrinsic worth. Value stocks, like those in utilities, offer stability but slower growth. They're ideal for conservative investors seeking steady returns. W is for watch list. Track stocks you're interested in before buying. Use your brokerage's tools to monitor price movements and news. This helps you make informed decisions without impulsive trades. X is for E, expectations. Set realistic goals for your investments. Don't expect overnight riches. Investing is a long-term journey. Aim for steady growth, like 7 to 10% annually. Y is for yield. Some stocks pay dividends, a share of profits. Dividend yield is the annual dividend divided by the stock price. High-yield stocks, like those in telecom, provide regular income. Z is for zero in on strategy. Create a plan and stick to it. Your strategy should reflect your goals, risk tolerance, and timeline. Stay disciplined, even when markets are volatile or emotions run high. Now let's explore the global market trends shaping 2025. First, tariffs are a major driver of market uncertainty. The US has imposed steep tariffs on Chinese imports, raising costs. This could lead to higher consumer prices and slower economic growth. China's economy is projected to grow below 5% this year. However, Chinese stocks are rebounding as Beijing rolls out stimulus. Second, technology continues to dominate global markets. Artificial intelligence is fueling growth in companies like Nvidia, but US restrictions on chip exports to China are hurting tech stocks. Third, interest rates are a critical factor for investors. The Federal Reserve is navigating inflation and growth concerns. Higher rates could cool markets, while cuts might spark a rally. In Europe, the ECB is cutting rates, boosting the stock 600 index. Japan's Nikkei has also risen, driven by favorable trade talks. How can new investors navigate this complex environment? Start small with diversified investments like ETF or index funds. Focus on stable sectors like healthcare or consumer staples. Keep some cash on hand to buy stocks during market corrections. Stay informed about global events, from trade deals to rate changes. Let's wrap up with a 5-step plan for new investors. Step 1. Define your financial goals and risk tolerance. Step 2. Open a brokerage account with a trusted platform. Step 3. Invest in ETFs or index funds for diversification. Step 4. Research individual stocks using fundamental analysis. Step 5. Monitor and rebalance your portfolio regularly. Investing is a marathon, not a sprint, so stay patient. Markets will fluctuate, but a disciplined approach leads to success. Let's dive deeper into some practical tips for beginners. Consider dollar-cost averaging to reduce the impact of volatility. This means investing a fixed amount regularly, regardless of market conditions. For example, invest $500 monthly in an S&P 500 ETF. Over time, this strategy can lower your average cost per share. Another tip is to reinvest dividends to compound your returns. Many brokers offer automatic dividend reinvestment plans for free. This can significantly boost your portfolio's growth over decades. Avoid emotional decisions, like selling during market crashes. History shows markets recover, so focus on long-term goals. Similarly, don't chase hot stocks based on hype or social media buzz. Stick to researched investments that match your strategy. Consider setting up a Roth IRA for tax-advantaged investing. In the US, Roth IRA earnings grow tax-free, ideal for young investors. Contribute annually and invest in diversified funds for maximum growth. Another strategy is to explore international stocks for diversification. Emerging markets like India or Brazil offer growth but carry higher risks. Use global ETF to gain exposure without picking individual stocks. Finally, track your progress and celebrate small milestones. Reaching your first $1,000 in gains is a big achievement. Keep learning, stay consistent, and your wealth will grow. Thanks for watching this A to Z guide to stock market investing. Subscribe for more tips and start your investing journey today.